Hello and welcome to this episode of Mutual Fund Masters. Joining me today is Balasubramanian, who's the Managing Director and CEO at Aditya Birla Sun Life Asset Management Company. Bala is a veteran of the mutual fund industry for almost 30 years. Thank you very much, Bala, for coming by in these very difficult times to share your perspective with our viewers. My first question to you, we are in a crisis right now as far as the second wave of Covid-19 is concerned. What is the kind of impact do you see this having on the economy and on the markets? We'll talk about markets in a bit, but on the overall economy and the economic picture of the country.
From the economy point of view, clearly I think after having seen last year around the same time, when the Reserve Bank of India and the Government of India all came together, and most of the central banks globally, they came and took a lot of measures in the form of pumping and liquidity, and they took many steps actually to revive the economic growth. I would assume at that point of time when they're dealing with that situation, there are many unknowns. They didn't have an answer actually how to address some of those issues that they were facing, but it took some time. At the same time, they also reacted very fast in terms of making the interest rates low and creating liquidity in the system very large. All such things that today, if you look at it, the unknowns were less, and there is no doubt, of course, the pandemic second wave is faster than the first wave. At the same time, since there has been limited unknowns, I would assume this will have a not major impact on the economic growth, given the fact that one side the vaccination numbers are rising, and at the same time the steps that are taken by the various government at all point of times have already started seeing its fruit in the last 3-4 months, and therefore it will continue the way it got progressed. Maybe in the month of May we could see a marginal slowdown, given the fact that the general expectation that May could be a month of peak with respect to the pandemic and impact. Let us assume that May turns out to be relatively a weaker month, and then subsequent month probably I would assume things could come back to normal. On the contrary, we'll probably see a little faster recovery, and given the fact that the lockdown has kept everyone locked for almost over 1.5 years period, therefore whatever the government steps that they have taken and the Reserve Bank of India continued assurance for keeping the interest rates low and liquidity high for a prolonged period of time, I think all combination put together, if you look at it, it could potentially have a positive impact on the economic growth. If not in the next 2-3 months, after 2-3 months, we must see an improvement in the economic growth.
One of the trends we saw, Bala, in the last 1 year is that a lot of retail investors preferred to go directly into the stock market rather than go through the mutual fund route. How do you see that trend playing out in the coming months?
Globally, the retail participation in equity market, whether directly or through the mutual funds, especially in the US, is pretty good. It's pretty high. Given the fact that interest rates have remained low for a considerable period of time, therefore, investors have been adapting to investing in equity as one way of savings, whether it is directly or through the mutual funds. In the US, of course, the mutual fund industry also is much bigger than the direct equity investing. But in India, also, I'm just happy to see that investors have gone back to the equity market during the pandemic period by way of improving their knowledge and understanding, using the publicly available information, and also new platform that has come. Very fact that number of people who open the demat accounts to buy into the equity market, that in my view is a good sign. And while of course one can criticize it, saying people are just going and trading and they will probably have not seen the cycles. While that could be true, the very fact that people are actually venturing into investing in equity as part of the long-term investment savings, which in my view is pretty good. So this only actually add value to the mutual fund, given the fact that the mutual fund have seen cycles, and mutual funds are managing diversified equity portfolio have generated reasonably good experience with investors who have been with the investments in mutual fund for the last many number of decades. Therefore, the investors gradually will migrate from direct equity to mutual funds, and somebody who has been, of course, investing only in mutual fund may also try their luck in the equity investing directly as well.
What should retail investors be doing right now, Bala? On the one hand, there is extreme volatility in the market, even though it seems to be holding up, as you mentioned earlier. But there is a lot of volatility. On the other hand, people are suffering, perhaps job losses coming up as well. What can retail investors do at this point of time?
continuous savings through the mutual fund is actually the key to build a longer term portfolio. And second is also just remember, exactly around the same time last year, people are worried about emergency funding. People are worried about whether will I have enough cash if I lose my job and so on and so forth. Just imagine somebody has remained invested during the pandemic period out of the investment that they made in mutual funds for many number of years. After seeing a substantial fall, the market price that moved up actually also increased the value of such investment.
Bala, you spent a lot of your earlier years tracking the debt markets. We talk a lot about equity, but how are debt returns playing out at this point of time? How do you see them, progressing in the future?
I think the debt market, as you rightly put it, Vivek, we've gone through cycles and debt market. We have seen very high interest rate regime. We have seen low interest rate regime. And as the equity market goes through, debt market also goes through ups and downs in terms of interest rates going up and down. Today, there is a high clarity that exists in fixed income portfolio management, which takes into account the risk that is involved on the back of interest rates moving up and down, and also credit-related issues that may happen. Each of the mutual funds have now been made more clearer from the investor's choice point of view, investor selection point of view. Therefore, I would assume from investor's point of view, stay invested in the short term so that you don't run the risk of potential interest rate hike that could come down the line 2-3 years. But one of the things that you must remember in fixed income schemes, there are two components that actually affects the NII of the schemes. One is the interest component, which of course every day accrues. Second is the mark-to-market fluctuation that comes on account of interest rates moving up and down. Third, of course, is the credit-related issue. Sometimes there will be credit defaults. If you look at all these three components, the largest component that drives the NII movement and return is actually interest accrual component. So when you have to get the real benefit of this, then one has to stay on such investment for a longer period, as long as you're a conservative fixed income investors, and then keep this in mind. Also the benefit that you get on a longer term basis, the tax benefit that you get on mutual fund fixed income schemes is far better than the benefit that you get in fixed deposits for any high taxpayers.
Bala, what are the sectors that you and your fund managers are tracking very closely with a 3 to 5 year kind of a horizon? Any new themes that are coming up in front of you at this point of time?
Yeah, high dominance would continue to remain from the financial services space, given the fact that they remain proxy to the economy. And second is the FMCGs, consumer durable companies, will remain the second big area of focus, along with the pharma as an industry. Because these are the industries which are not built for short term, they are the industries built for the longer term. Therefore, they remain one of the big focus area for money managers, so that they all become part of our core portfolios, irrespective of whatever happens in the economy, the political environment. These companies are built actually for long lasting in nature. That second set of sectors, which is what I think we all look at, the cyclical sectors, which are, we can divide them into two types, global cyclical sectors and domestic cyclical sectors. The global cyclical sectors, if you look at the commodity space, there are global cyclical sectors. There is a high likelihood of cyclicals of global in nature. Global cyclical sectors would probably will probably do very well for the next few years. The last, of course, is given the fact the interest rates remaining low, maybe once the pandemic issues, I think, is completely come out of the crisis, the low interest rate regime would actually drive the consumption demand, and especially in auto sectors. You'll probably see the auto sector, which call it a domestic cyclical, I can call it, and they would also probably see some kind of revival as we move forward, given the fact the low interest rate regime ultimately has to increase the spending power of people by borrowing. At the same time, last 1 year of pandemic period have also increased the savings pool in the hands of people. Therefore, these two combinations will drive the consumption spending as we move forward. Therefore, we also see some revival in the domestic cyclical sectors, such as autos, including tourism as a sector will come back probably after, say, 6 months or so.
All right, we leave it there, Bala. Thank you very much once again for coming by and sharing your perspective with our viewers here on Money 9. Thank you.